13 Lessons from Peter Lynch that will make you a better retail investor. Peter Lynch has one of the most impressive track records in fund manager history. He achieved an annual compounded growth rate of 29.2% for 13 years, outperforming the S&P by a factor of 2. 13 Lessons from Peter Lynch. You want to understand a company's DNA and why you hold a specific stock. Buying a stock because the price has gone up 100% is a bad idea. Buying based on a deep understanding of the business is much smarter. A solid balance sheet is always essential. A business with low/no debt and a lot of cash on its balance sheet will not go bankrupt. Some companies fuel their growth using debt but are unable to grow without it. This is where retail investors lose a lot of money. Invest in boring companies. Keywords: low analyst coverage, mundane, currently unpopular. Dull companies with no hype are likely to yield better investing opportunities than anything you will find in financial news. Professional investors are a herd because they are formed and restricted by their fund's policies and their fears of keeping their jobs. Retail investors can gain an edge by ignoring this herd and doing independent research based on one's unique knowledge. Never invest in a stock based on a tip. No matter how smart the person that gave you this tip is, do your own work. You have no idea if this person has a small or big position. And you don't know if he is hedged or doing some other advanced play. Retail investors should not have more than 10 to 12 stocks at any given time. This is because owning stocks is like having children. Don't get involved with more than you can handle. As a part-time investor, keeping up with more than 10 to 12 companies can be a challenge. If a business decides to enter into a new strategic direction, be cautious. This could be a new business segment or an acquisition. Companies often end up worse off after this, what Lynch refers to as diversification. Lynch encourages investors to use the edge they have over institutional investors. We all have 9-5s, hobbies, interests, and other domains where we know more than 95% of the population. Leverage this knowledge into investment ideas. Never invest the same day/week of discovering a new stock. You are likely to be affected by FOMO and greed. Instead, let it digest for at least 2 weeks, and see how you feel about the investment then. This will provide you with a much clearer mind when deciding. For retail investors, stock market declines are opportunities. This is an essential mind shift change. Stocks declining means that you will get a better future return on the stocks you want to buy at bargain prices. Never invest in companies without understanding their finances. Know how the business makes money. Know which products drive growth and earnings. Know how much cash the business is generating. Know how much debt they have and need. Peter Lynch famously did not waste any time studying macroeconomics. He had a bottom-up approach focused on businesses' performance. He believed that most time investors used trying to predict the interest rate was a complete waste. For more videos like this, please subscribe to our YouTube channel Investor Affairs.